but it is absolutely possible and it is contractual. It's legal. It's not too good to be true. Hey there, I'm John Stevenson, the Guaranteed Retirement Guy, and today we're going to be talking about how you can get $56,000 a year in guaranteed lifetime income from only $200,000. Now, the reason why I wanted to do this little exercise is because I recently recorded a video about how to get $46,000 a year from only $350,000, and I had a lot of people who were super skeptical, thought I was lying, thought I was trying to pull a fast one on you.
That's just impossible. There's just no way that can happen. You're just trying to sell an annuity.
Well, guess what? I'm going to share my screen with you and I'm going to show you the actual numbers, how this works. We're going to pull back the curtain and we're going to see how you can take $200,000 and have a huge return from it. Okay, now there are some rules, there's some restrictions, right? There's some things you gotta do to make it happen, but it is absolutely possible and it is contractual, it's legal, and it's been around for a long time. It's not too good to be true. So without further ado, let's take a look at my screen. Okay, so what I did is I took a male, 50 years old in Nevada, and I put $200,000 into a fixed index annuity with an income rider. Okay, simple enough, right? Now here's really the kicker. Here's how it works. I deferred it for 20 years. Okay, it wasn't instant because yeah, it is kind of too good to be true to take $56,000 out a year guaranteed right at the beginning. You need to give the insurance company time to grow this money. And this is how it's done. So we're starting income at age 70. And of course, if you started earlier, it's going to be less than the $56,000. But we're basing this off of someone who's 50 years old. They want to put $200,000 in. They're a single male or they're married and they want to just do a single payout. Although usually when you're married, you want to do a joint payout, which depending on your spouse's age will change that payment as well. But based off of a 50-year-old male who wants a single payout and they want to defer this annuity for 20 years and take income at 70, they will absolutely get $56,000 a year. $56,202. And that is with American Equity. And I'm going to show you exactly why and how that works. And you can see all the rest of annuities, they pay out less. Some of them in the $30,000 and $40,000 range per year. And you might ask, well, how is American Equity doing this? Well, I'm going to show you. So we're going to pull up the illustration and I wanted to show you how the income rider works. Because whenever you have an income rider attached to an annuity, it has a roll-up rate. And a roll-up rate is just a rate of return that you get every year for the purpose of receiving income later on. You also have a withdrawal rate that it is multiplied against that gives you that high amount of income. So I'm going to show you exactly how this works. And this is in the contract. In fact, before we look at the numbers, let's read the contract. If we go down here, you'll notice it has a 10% premium bonus. What does that mean? Well, it means if he puts $200,000 in, right when it's funded and the policy is issued, you'll log into your account and you will see $220,000 sitting in that account. Okay, so that's the first part. The second part is this particular annuity is the Income Shield product. Okay, and you'll notice it gives you a 6.5% roll-up, which means the account is getting a 6.5% compounded growth every single year for up to 20 years. And you notice that right there. It says the rate is 6.5 compound interest for 20 years. Okay, written in stone. This is not by me. This is from American Equity. Okay, American Equity is known for being the best for having deferred income annuities because they give you such a long roll-up rate. Most companies are usually giving you a roll-up rate that lasts 10 years, maybe 12, maybe 15 years, but I haven't seen any that will do it this long, not like this, and give you such a high withdrawal rate. So this is why American Equity is a great solution if you are far away from retirement. Now, if you're close, within 5 years, they're not. Okay, there's other companies that are better for that. But if you are, 15 to 20 years away from retirement, more than likely American Equity right now is going to be the best solution for the highest income. So let's go up to the numbers and I'm going to show you how this works. If you notice on the benefit base, you see the beginning contract value here. It says $220,000. Okay, remember I talked about the 10% premium bonus? That's what you're seeing right there, $220,000. Now here's the thing. At the end of the first 12 months, it earns that 6.5%, right? So you'll notice the ending benefit base is $234,300. That's because $220,000 was multiplied by 6.5%. The second year, same thing. Now it's $234,000 multiplied by 6.5, and you got $249,000 as a balance. So this happens every single year, and you have that compounded growth. And you notice over time, over that 20 years, it's going to grow to a benefit base, an income benefit base of $779,202. And the lifetime withdrawal rate also grows contractually to a 7.25% withdrawal rate, which means when they are both multiplied against each other, it gives you $56,202 for the rest of your life. That's awesome. That is how that works. Okay, you're giving the insurance company enough time to make a profit with your money and to give you the growth that they promised in the contract so that the account balance is worth a lot more than $200,000. Now you have $775,000 multiplied against the 7.25%. Now you might be saying, well, John,
if I got to wait 20 years, I might as well just leave that in the stock market. The stock market's averaged that for the last, several decades.
And I would say, yeah, of course it has. You could definitely do that. The difference between this and that is the fact that this is guaranteed. The stock market is not. We do not know when it's going to go up, when it's going to go down. And we don't know if and when you decide to retire, if the market will be down or up. And that's going to greatly affect the amount of income that you'll get. Not to mention the withdrawal rate. Okay, you might have an immediate annuity that you decide to purchase at that point in 20 years from now that does not have the 7.25% withdrawal rate. Okay, and then what if your account balance didn't quite hit the 775? You went through some ups and some downs and you happened to retire when the market was on a down curve. Okay, that happens. And so because of that, your income will be smaller. So you have to think about that. And another reason is this isn't to compete with the stock market. They both have a purpose. Stock market is for growth. And when you don't mind the risk and the roller coaster, it's fine. In fact, I always tell people, don't take all of your money out of your portfolio for an annuity, right? Insurance companies won't take it all anyways. Just take the amount that you need for the guarantees in your income requirements for your retirement. That's all, okay? No more, no less. It's really that simple. So now you can see that this is not too good to be true. I wanted to make sure that I shared my screen this time because last time I got a lot of flack from people that really thought that I was just trying to sell them something and blow some smoke, throw in a few exaggerations, and it's not. Okay, when you set it up right and you have the growth for the amount of time that you need it for, you can get a lot of income. Now, you may have a lot less than 20 years for retirement, and that's fine. At that point, you just have to put more money into it. You can still get a very, very decent return even if you're 2 or 3 years out. Okay, there are other roll-up rates from other annuities that are higher than 6.5%. So it just depends on you and your unique situation. But I'm going to show everything to you. Okay, I think that is important. Transparency is super important in this business, and unfortunately, there's a ton of agents out there that won't do it. They'll sell you 1 or 2 annuities or just show you one, and they'll recommend it and they'll push it on you. And it's a good annuity. There's nothing wrong with it. The problem is they're not showing you the other annuity that's paying them less commission that will give you more lifetime income. And that is, to me, wrong. So anyways, if any of that makes sense to you, and you want some transparent advice, you want to work with someone who's going to take care of you, who's going to be in your corner, then I would recommend that you get on my calendar. You'll see there's a link below this video and we can chat. We'll look at your unique situation and we'll see exactly what you want for your income. And we'll look at all of your other income sources and then we'll solve for any type of income gap that you might be suffering during retirement. And we'll fix that with an annuity. So anyways, I won't try to sell anything. We'll just go over the top annuities and then you can decide for yourself what you want. So anyways, I hope this helps. I appreciate you watching, and we'll see you next time. Hey there. I hope you enjoyed this video. If you've got questions, please share them in the comments below. We love hearing from you.